Hello, everyone, and welcome to this video covering Chapter 11, Reporting for Control. The learning objectives for this chapter include the understanding the difference between decentralization, segmented reporting, the concepts of costs, profit, and investment centers, and how to calculate and use return on investment and residual income as two metrics for evaluating the performance of investment center managers. First, a look at decentralization and segmented reporting. The concept of centralization or decentralization basically is related to where decision-making sits, the locus of decision-making. So if an organization were decentralized, the decision-making is typically spread throughout the organization rather than being limited to a few top executives, which would be the case for a centralized organization. The use of segmented reporting helps decentralization in allowing the analysis and evaluation of decisions that are made by segment managers that are empowered to make important decisions pertaining to the segments that they are managing. Segmentation can occur at different levels. For example, we could have segmentation at the divisional level, at a product line level, or at the level of sales territories for individual product lines of a particular division. It is more useful to prepare segmented income statements using the contribution format. The reason being that the fixed costs incurred at an organizational level may be traceable to a particular segment or not. If such costs are not traceable to a particular segment, then they have to be allocated amongst the segments. Let's take a look at example 11, exercise 11-5. We're given information about Shannon Company, which segments its income statement in its North and South division. So there are two divisions, the North and the South division. The company's overall sales contribution margin ratio and net operating income are 500,000, 46%, and 10,000 respectively. The North Division's contribution margin and contribution margin ratio are 150,000 and 50% respectively. And the South Division segment margin is $30,000. The company has $90,000 of common fixed costs that are not traceable to either division. The requirement is to prepare an income statement for the company using the contribution format and segmenting by division. So we will set up the income statement in this manner. We'll have a column for the entire company. We'll show the amount and the percentage of sales. And then we will split that amount for the total company into the two divisions, the North Division and the South Division. So we'll begin with sales. Keep in mind that we prepare the segmented income statement using the contribution format. So sales minus variable costs will give us contribution margin. Now, after contribution margin, we try to trace the fixed costs that are capable of being traced to the individual divisions. So we will subtract the traceable fixed costs, and I'll talk about these in a minute, to get the territorial segment margin. And once you've got the segment margin for the divisions or the territories, then we can subtract the common fixed costs to arrive at the operating income. Now, we were given information about this company that its sales were $500,000. Its contribution margin ratio is 46%, and that its operating income is $10,000. We're also told that the North Division has contribution margin of $150,000, which is 50% of its sales. Also, the South Division's segment margin is $30,000. And for the entire company, there are common fixed costs totaling $90,000. So that's a useful thing to start. We've been given some information. The rest of the information we'll have to essentially calculate. So this would be an example of not just how to prepare a segmented income statement with all the information provided to us. We actually need to back calculate some of the stuff. Hopefully, this will be good fun as a bit of a puzzle as well. So how do we go about doing this? Well, okay, so we have sales of 500,000 for the total company. Well, if that was 100%, and we are told that the contribution margin is 46%, then 100 minus 46, the variable costs as a percentage of sales will work out to 54%. Now that 54% times 500,000, the total sales, give us $270,000 as variable costs for the entire company. And 500,000 sales minus the variable costs of 270,000 give us contribution margin of 230,000. Next up, if we look at the operating income being $10,000, and the common fixed costs are $90,000, adding backwards, we get 10,000 plus 90,000. The total territorial segment margin, therefore, is 100,000. And that 100,000 is obtained after subtracting the traceable fixed costs from the contribution margin. So given the fact that our contribution margin is 230,000 and the territorial segment margin is 100,000, we can calculate the total traceable fixed costs to be $130,000. After calculating the traceable fixed costs, we can then proceed to calculate the percentage of sales. So $130,000 of fixed costs as a percentage of $500,000 works out to 26%. The territorial segment margin is 20%. The common fixed costs work out to 18%. And the operating income of $10,000 is 2% of the total sales for the company. Next, we will calculate the amounts and the percentages for the two divisions. Now, it is important to note that when we are doing the calculation for the divisions, we only compute the amounts up to the segment margin row. Okay, so we do not calculate any amounts after the segment margin row. So for the North Division, if sales were 100%, given the fact that contribution margin is 50%, we would see that the variable costs for the North Division would be 50%. Now, we already know what 50% of sales is. We know that the contribution margin is 150,000. So variable costs will also be 150,000. And we can work backwards to get sales of $300,000. Alternatively, what we could have done is divided the 150,000 by 50% to get 300,000 for the sales dollars. Okay, so if total sales were 500,000 and the North Division has $300,000 in sales, then 5 minus 3, 200,000 must be the sales amounts for the South Division. Similarly, if the total variable costs for the company are 270,000, and of that 150,000 were incurred in the North Division, then 270 minus the 150, 120,000 is the variable cost for the South Division. We can get the contribution margin, 200 minus 120, $80,000. Now that 80,000 as a percentage of sales, well, the South Division's sales are 200,000. So 80,000 as a percentage of sales works out to 40%, and our variable costs are 60%. The fact that the segment margin for the South Division is 30,000 and the contribution margin is 80,000 helps us calculate the traceable fixed cost for the South Division as being 80 minus 30, $50,000. Now, $50,000 as a percentage of the South Division sales of 200,000 works out to 25%, leaving 15% as the segment margin for the South Division. Looking at the total territorial segment margin of 100,000, given the fact that the South Division's segment margin is 30,000, we can calculate the North Division's segment margin, $70,000. And considering the contribution margin is 150,000, the difference gives us the traceable fixed costs, $80,000. As a percentage of the $300,000 of total sales, these amounts represent 26.7% and 23.3% respectively. Looking at cost, profit, and investment centers, any business segment whose manager has control over costs or profits or the use of investment funds is known as a responsibility center. So the manager can have control over revenues, can have control over costs, can have control over investment funds. And then depending on what aspects of the business the manager has control over, there is a specific term used to describe that responsibility center. And we'll take a look at an example. So first one is if the manager is responsible for revenues, but not costs or the investment funds, then that particular responsibility center is called a revenue center. Example of that would be the sales department of a company. If, on the other hand, the manager is not responsible for controlling costs, or revenues rather, but is responsible for controlling costs, but doesn't have any authority or say over investment funds, then that would be an example. That responsibility center is called a cost center. And typical examples would include accounting, HR, marketing, etc. Where the manager has control over both revenues and costs, but not investment funds, we call that responsibility center a profit center. An example of that might be your typical retail store. So for example, a no-frills store, the manager of that no-frills store has some authority, some say over the pricing. They are able to put on manager specials, etc. And they're also responsible for controlling costs, but they don't have much say over the deployment of investment funds. Where the manager is responsible for not only the profitability, but also has authority and control over investment funds, then that responsibility center is called an investment center. And an example of that might be, say, the auto financing branch of Toyota. Where a company has investment centers, two commonly used performance evaluation metrics are return on investment, ROI, and residual income, or RI. Return on investment. The formula is you want to divide operating income, which is earnings before interest and tax, by the average of the operating assets. You can also calculate ROI by multiplying margin with turnover, where margin is defined as the operating income divided by sales, and turnover is sales divided by average operating assets. And you can see if you were to multiply margin by the turnover, sales will cancel out and you'll end up with operating income over average operating assets, which is the original formula for the ROI. Operating assets, by definition, will include cash, accounts receivable, inventory, plant and equipment, and all other assets that are used for productive use within the organization. So it does not include any kind of passive investment in some other company. So if you have ownership in some other company, well, that's a passive investment that wouldn't be included in the operating assets. If you have, say, some assets that are not currently being used, but rather are being held for sale, then those assets would not be considered up. You'll exclude those assets. To calculate the average of the operating assets, you simply take the beginning and the ending operating assets and divide them by 2. If we don't have beginning and ending operating assets information, then simply use the amount provided. So just use the ending operating assets. It will not be perfectly conform. It won't conform to the formula, but you'll still be able to compute. If you were comparing, as long as you calculated the amount on the same basis, there should be some comparability. Now, typically, a higher return on investment is seen as a good thing. So how can managers try to increase return on investment? Well, there's 3 possible ways of achieving that. One is to try to increase sales. If you have higher sales, you should have higher contribution margin. If there's no increase in fixed costs, then that should result in higher operating income, and a higher operating income will mean higher return on investment. Another way is to try to reduce the operating expenses. Operating expenses go down, then operating income is higher, and that would mean a higher return on investment. A third way of achieving an increase in return on investment is if we could keep sales, the operating income amounts constant, but can reduce the operating assets. Lower operating assets would mean a higher return on investment as well. Here's a look at an example from the textbook. We're given some information about 3 divisions of a company: the Fab division, the consulting division, and the IT division. And you have information on sales, operating income, average operating assets, margin, turnover, and return on investment. Just remember that return on investment is calculated by dividing operating income by the average of operating assets. It can also be calculated by multiplying margin with turnover. Margin is calculated by dividing operating income by sales. Turnover is calculated by dividing sales by the average operating assets. So you'd notice that there are some numbers given and there are some question marks, i.e. these are gaps, these are blanks that we have to calculate. So we start with a look at the Fab division. We're given sales of 800,000, operating income 72,000, and return on investment 18%. Now, we know that margin is calculated by dividing the operating income by sales. So we have operating income of 72,000. We have sales 800,000. We divide 72,000 by 800,000, we get margin 9%. We also know that margin times turnover equals return on investment. So margin 9% times turnover, something, equals 18%. Well, if you ask yourself the question, 9 times what equals 18, you'll get the answer to be 2. So the turnover is 2. To calculate the average operating assets, we can use the information on the turnover and sales. So turnover is simply sales divided by average operating assets. So 800,000 divided by something equals 2. Well, that's something. The average of operating assets is basically half of sales, or 400,000. You could alternatively have calculated average operating assets by dividing the operating income. So we knew the operating income was 72,000. We also knew the return on investment was 18%. 72,000 is 18% of 400,000. Divided 72,000 by the 18% ROI, we could have gotten the average operating assets. For the consulting division, we are given an average operating assets 130,000, margin 4%, turnover 5. So here, margin 4% times turnover of 5 gives us return on investment 20%. And taking ROI of 20% and the average operating assets 130,000, we can calculate operating income. Operating income is 20% of 130,000, $26,000. Finally, we can calculate sales. We know the average operating assets are 130,000, and we're given turnover is 5. So sales is 5 times 130,000 for $650,000. Looking at the IT department's numbers, we have operating income 40,000, margin 8%, ROI 20%. So we know that margin 8% times something equals ROI of 20. So 8 times what equals 20? Well, that works out to 2.5. Taking the 2.5, we can try to calculate the average operating assets. So average operating assets, what we can do is, we have operating income 40,000, and we are told that the return on investment is 20%. So 40,000 is 20% of the average operating assets. The 40,000 divided by 20% gives us average operating assets 200,000. And then to calculate sales, we can either divide 40,000 by 8%, the margin, or we can multiply the average operating assets of 200,000 by the turnover 2.5 times to get sales $500,000. Next up, a look at residual income. So residual income is the operating income that an investment center earns over and above a minimum required return on its operating assets. So the calculation is you take the operating income and subtract from the operating income the average operating assets multiplied by a minimum required rate of return percentage. So that percentage is established by the company's management, its board of directors. So you would look at the average operating assets employed by the division, multiply the average of those operating assets with the minimum required rate of return to get the minimum required income, subtract that minimum required income from the operating income to get residual income. You can also calculate residual income by multiplying the average operating assets with the excess of the return on investment over the minimum required rate of return percentage. Taking a look at an example, this is exercise 11-8 from the textbook. Ferris Ltd of Australia has 2 divisions, one in Perth, one in Darwin. You're given information about 2 divisions there, 2 divisions, Perth and Darwin. Sales, Perth had sales of 9 million, operating income of 630,000, and employed average operating assets of $3 million. Darwin, on the other hand, had sales of $20 million, operating income 1.8 million, and operating assets were $10 million. The first requirement is to calculate the return on investment for each division. ROI, the calculation is operating income over average operating assets. So for the Perth division, operating income of 630,000 divided by the average operating assets of 3 million equals the ROI 21%. For the Darwin division, it's 1.8 million over 10 million, 18%. Now, comparing the two, the Perth division has a higher return on investment. Same facts, the second requirement. Assume that the company evaluates performance using residual income, and the minimum required rate of return for any division is 16%. Calculate the residual income for each division. So here, the calculation for residual income is operating income minus the minimum income. The minimum income is 16%, the minimum required rate of return, times the average operating assets. So for the Perth division, 16% of 3 million works out to $480,000, $630,000 of the operating income minus the minimum income of 480,000 equals residual income $150,000. In comparison, for the Darwin division, operating income of 1.8 million minus the minimum income, 16% of 10 million, 1.6 million, gives us residual income $200,000. So in terms of residual income, the Darwin division has a higher residual income. Continuing with the question, is the Darwin division's greater residual income an indication that it's better managed? Explain. Now, the short answer to that is not necessarily. The reason is that when you have larger divisions, they will typically have larger residual incomes simply because of their size, right? So they have more operating assets involved, deployed, they likely will have more sales and will have likely higher operating incomes compared to the smaller divisions. Now, if you were to compare the two divisions on the basis of ROI, the Perth division is much more profitable than Darwin. So short answer is whether a division is doing better than another does not solely depend on the residual income. It should be, you should look at a multiplicity of factors. Another example, this is an example from the textbook exercise 11-11. FitPlus is a regional chain of health clubs, with each club's manager having the authority to make investments as needed and largely evaluated based on ROI. So FitPlus Club 52 reported the following results for the past year: sales 500,000, operating income 15,000, average operating assets $80,000. We're going to be looking at each of those questions independently, carry out all computations to 2 decimal places. First, calculate the club's return on investment currently. The current return on investment is the operating income of 15,000 over average operating assets of 80,000, 18.75%. Same facts. Assume that the manager of the club is able to increase sales by $80,000, and that as a result, operating income increases by 6,000. Further assume that this is possible without any increase in operating assets. What would the club's ROI be in this case? So over here, we're not that interested in the increase in sales. We know that if sales goes up, everything, there should be an increase in operating income. So that is our concern. By how much does operating income change? So currently the operating income was 15,000. With the increase of $6,000, the new operating income will be 21,000. Since there's no change to the average operating assets, they remain $80,000, the return on investment will now become 21,000 over 80,000 or 26.25. So you notice here, if sales went up, the result was an increase in operating income, the result being an increase in ROI. Same facts. Assume that the manager of the club is able to reduce expenses by $3,200 without any change in sales or operating assets. What would the club's ROI be in this case? So remember the relationship between operating expenses and operating income. If your expenses go down, the operating income will go up. So if operating expenses go down by 3,200, the operating income will go up by $3,200 to 18,200. With no change to the average operating assets, the new return on investment is 22.75%. That's a typo there. It should be 22.75%. Finally, assume that the manager of the club is able to reduce operating assets by $20,000 without any change in sales or operating income. What would the club's ROI be in this case? So if operating assets went down by 20,000, the average operating assets go down by 20,000, but the operating income stays at $15,000, then the return on investment amount will be 15,000 divided by $60,000 or 25%. That's all I had for this little video. We will be doing examples from chapter 11 in class. Chapter 11 typically is examined as multiple choice questions. We don't know as of now how the final exam, final structure is going to look like. So as of now, what I would encourage you folks to do is do as many practice questions as you can from chapter 11, and also try to complete your connect problems. As we get closer to the final exam date, I'll have more information about whether you can expect a longer problem from chapter 11 or whether it will still be examined as multiple choice. Till then, bye-bye.